Good afternoon, class, or good morning. I don't know where you are. Anyway, it's good to talk to you again. We will cover Chapter 11 today. Chapter 11 deals with the international banking system and money markets. Here are the topics to be covered. We will talk about international banking services, the reasons for international banking. We will discuss the different types of international banking offices. We will talk about capital adequacy standards. We will discuss international money markets. We'll talk about the international debt crisis of 2007/2008. We will talk about the Asian crisis, and we will talk about global financial crisis, and we will conclude with a summary. So without any further delay, let's get started. International banking services. International banks can be characterized by the types of services they provide that distinguish them from domestic banks. Well, international banks facilitate the imports and exports of their clients by arranging trade financing. They serve their clients by arranging for foreign exchange necessary to conduct cross-border transactions and make foreign investments. They assist their clients in hedging exchange rate risk through forward and options contracts. They trade foreign exchange products for their own accounts. The major features that distinguish international banks from domestic banks are the types of deposits they accept and the loans and investments they make. Large international banks both borrow and lend in the euro currency market. Now, the euro currency market holds a special place in my heart. Early on in my career, I did a lot of research dealing with the functioning of the euro currency market. I have a few of those articles available for those of you that may be interested in taking a look at them. Let me know. I'll be more than happy to share with you. Now, banks are frequently structured as bank holding companies so that they can perform both traditional commercial banking functions and engage in investment banking activities. Here's a list of the world's 30 largest banks. Right? ICBC from China, China Construction Bank, Bank of China, and the list goes on and on. Now, what are some of the reasons given for international banking? Well, low marginal cost is one reason frequently given. Managerial and marketing knowledge developed at home can be used abroad with very low marginal cost. Another reason for international banking has to do with knowledge advantage. A foreign bank subsidiary can draw on its parent bank's knowledge of personal contacts and credit investigations for use in that foreign market. Another advantage is home nation information services. Local firms in a foreign market may be able to obtain more complete information on trade and financial markets in the multinational bank's home nation than is obtainable from foreign domestic banks. Prestige, my dear friends, is another one. Prestige. Very large multinational banks have high perceived prestige, which can be attractive to new customers. Yes, I want to bank with this bank because I heard many good things about it. So prestige is very important. Regulation advantage is another reason for international banking. Multinational banks are often not subject to the same regulations as domestic banks. Wholesale defensive strategy. Banks follow their multinational customers abroad to avoid losing their business at home and abroad. Retail defense strategy is another reason for international banking. Multinational banking operations help a bank prevent the erosion of its travelers' check, tourists, and foreign business markets from foreign bank competition. Transaction cost is another big one. Okay, this is another important reason for international banking. Multinational banks may be able to circumvent government currency controls, thereby lowering their transaction costs. Growth. Foreign markets may offer opportunities for growth not found in the domestic market. Risk reduction. I'm confident that you heard of the concept of diversification in your prior finance courses. Risk reduction here has to do with the greater stability of earnings that one can derive from diversification, that is, from having operations in multiple locations, in multiple countries. Now we would begin our discussion of the different types of international banking offices. Okay? There's the correspondent bank, representative offices, foreign branches, subsidiary and affiliate banks, Edge Act banks, offshore banking centers, and international banking facilities. Let's review them one at a time. Correspondent bank. A correspondent bank relationship is established when two banks maintain a correspondent bank account with one another. This is beneficial because a bank can service its multinational corporation clients at a low cost without the need of having bank personnel physically located in many different countries. A main advantage is that the bank's clients may not receive the same level of a main disadvantage, a main disadvantage is that the bank's clients may not receive the same level of service. Now, correspondent banking allows a bank's multinational corporation client to conduct business worldwide through its local or its contacts. Representative offices. Well, a representative office is a small service facility staffed by parent bank personnel that is designed to assist multinational corporation clients of the parent bank in dealings with the bank's correspondence. It serves as a way for the parent bank to provide its multinational corporation clients with a level of service greater than that provided through a correspondent relationship. Representative offices also assist multinational corporation clients with information about local business practices, economic information, and credit evaluation of the multinational corporations' foreign customers. Foreign branches. A foreign, a foreign branch bank operates much like a local bank, but is legally a part of the parent bank. Branch banking is the most popular way for U.S. banks to expand operations overseas. It is subject to both the banking regulations of the home country and the country in which it operates. A foreign branch bank may be established for various reasons. Among them are the following. It can provide a much fuller range of services for its multinational corporation customers than can be provided through a representative office. The books of a foreign branch are part of the parent bank's books. It facilitates a competition on a local level with the banks of the host country. Subsidiary and affiliate banks. Both subsidiary and affiliate banks operate under the banking laws of the country in which they are incorporated. A subsidiary bank is a locally incorporated bank that is either wholly owned or owned in major part by a foreign parent. An affiliate bank, on the other hand, is one that is only partially owned but not controlled by its foreign parent. U.S. banks find subsidiary and affiliate banking structures desirable because they can underwrite securities as well. Edge Bank, Edge Act banks. Okay, the Edge Act Bank Act was established in 1919, okay, as an amendment to Section 25 of the 1914 Federal Reserve Act. Edge Act banks are federally chartered subsidiaries of U.S. banks that are physically located in the U.S. and can engage in a full range of international banking activities. These banks are typically located in a state different from that of its parent company in order to get around the prohibition of interstate branch banking. These banks are not prohibited from owning equity in business corporations, unlike domestic commercial banks. Offshore banking centers. An offshore banking center is a country whose banking system is organized in such a way to allow external accounts beyond the normal economic activity of the country. Offshore banks operate as branches or subsidiaries of the parent bank. The principal features that make a country attractive for establishing an offshore banking operation are virtual total freedom from the host country governmental banking regulations. The International Monetary Fund has recognized the Bahamas, Bahrain, the Cayman Islands, Hong Kong, Panama, and Singapore as major offshore banking centers. International banking facilities, what are they? An international banking facility, or IBF, is a separate set of asset and liability accounts that are segregated on the parent bank's books, though it is not a unique physical or legal entity. Any U.S. chartered depository institution, a U.S. branch or subsidiary of a foreign bank, or a U.S. office of an Edge Act bank may operate an international banking facility. International banking facilities were originally established largely as a result of the success of offshore banking. International banking facilities have been successful in capturing a large portion of Eurodollar business previously handed offshore. And here is the organizational structure of international banking offices from the U.S. perspective. That is, we're looking at this from the United States of America. Now, if you look at a domestic bank, for example, well, since we're looking at this from the prism of the U.S., it has to be located in the U.S. Can it accept foreign deposits? No. Can it make loans to foreigners? No. Is it subject to the Federal Reserve requirements? Yes. Is it FDIC insured? FDIC stands for Federal Deposit Insurance Corporation, which is the entity that insures banks in the United States. So yes, you have to be FDIC insured. Okay. Can you operate a separate legal entity from the parent? No, no. Capital adequacy standards. Bank capital adequacy refers to the amount of equity, capital, and other securities a bank must hold as reserves against risky assets in order to reduce the probability of bank failure. Three pillars of capital adequacy, the three pillars, of capital adequacy are minimum capital requirements, supervisory review process, effective use of market discipline. Basel III was announced on September 12, 2010. It was designed to substantially strengthen the regulatory capital framework and increase the quality of bank capital. On December 7, 2017, the Basel Committee announced additional reforms to Basel III that seek to restore credibility in the calculation of risk-weighted assets and improve the comparability of banks' capital ratios. Okay. They are scheduled for implementation through the current year, 2021. International money market. I mentioned earlier that early on in my career, I did a lot of research on this particular market, on the euro currency market. It's a very fascinating market. So what is a euro currency really? A euro currency is a time deposit in an international bank located in a country different from the country that issued the currency. For example, euro dollars are deposits of US dollars in banks located outside of the United States, while euro sterling are deposits of British pound sterling in banks outside of the United Kingdom. The euro currency market is an external banking system that runs parallel to the domestic banking system of the country that issued the currency. The origin of the euro currency market can be traced back to the 1950s and 1960s. The euro currency market operates at the interbank and or wholesale level, with most transactions being interbank transactions in the amount of $1 million or more. The common reference rates include LIBOR, or London Interbank Offered Rate, SIBOR for Singapore Interbank Offered Rate, and TIBOR for Tokyo Interbank Offered Rate. The Euribor is the rate at which interbank time deposits of the euro are offered by one prime bank to another in the Eurozone. Where London has historically been and remains the main or the major euro currency financial center. Now, exit, however, may alter this. Brexit may change this. Only time will tell. Euro credits. Euro credits are short to medium term loans of euro currency extended by euro banks. Loans are denominated in currencies other than the home currency of the euro bank. Because the loans are often too large for one bank to handle, euro banks will band together to form a bank lending syndicate to share the risk. The credit risk on these loans is greater than on loans to other banks in the interbank market. Interest rate on euro credits must compensate the bank for the added credit risk. Forward rate agreements, these are very important instruments. Okay, a major risk euro banks face in accepting euro deposits and is in extending euro credits is interest rate risk resulting from a mismatch in the maturities of the deposits and the credits. Okay. An interbank contract that allows the Eurobank to hedge the interest rate risk in mismatch deposit uh, on credits is a forward rate agreement. A forward rate agreement involves two parties: a buyer that agrees to pay a seller the increased interest cost on a notional amount if interest rates fall below an agreed rate, and a seller that agrees to pay a buyer the increased interest cost if interest rates increase above the agreed rate. Forward rate agreements can be used for speculative purposes also. Here's what a payoff profile for a forward rate agreement would look like. This is the short position, or the person that sold the forward rate agreement. This is the long position, that is, or the person that purchased the forward rate agreement. As you can see, AR here stands for the agreement rate, and SR stands for the settlement rate. Okay. Forward rate agreements are structured to capture the maturity mismatch in standard length euro deposits and credits. Very simple example: the forward rate agreement might be on a 6-month interest rate for a 6-month period beginning 3 months from today and ending 9 months from today. This would be a 3 against 9 forward rate agreement, and this is the timeline. Okay, you make the agreement. This is the agreement period, three months. Okay, and the remaining 6 months here would constitute the forward rate agreement period, which begins again 3 months from now and ends in six months. So you have a total of nine months. The payment amount under a forward rate agreement is calculated as the absolute value of this expression, where days stands for the length of the forward rate agreement. SR again is the settlement rate, AR is the agreement rate, and you have to remember this simple rule. This rule will come in very handy, right? Okay. It tells you what to do depending on the relationship between the settlement rate and the agreement rate. If the agreement rate is greater than the settlement rate, then you should sell the forward rate agreement. Okay. If the agreement rate is less than the settlement rate, then you should buy the forward rate agreement. And very quickly, I'll give you an example on the next slide. Okay, a 3 against 9, that is similar to the one that we were looking at earlier. A 3 against 9 forward rate agreement has an agreement rate of 4.75%. That's your AR. You believe 6-month LIBOR in 3 months will be 5.125. You then decide to take a speculative position in a forward rate agreement with a $1 million notional value. There are 183 days in the forward rate period. Determine whether you should buy or sell the forward rate agreement and what your expected profit will be if your forecast is correct about the 6-month LIBOR rate. Now remember the strategy that I mentioned earlier, right? So here's the solution. Since the agreement rate is less than your forecast, you should be buying the forward rate agreement. If your forecast is indeed correct, your expected profit is 1,857.61, okay, using the formula on the prior slide. Euro notes. Euro notes are short-term notes underwritten by a group of international investment or commercial banks called a facility. A client borrower makes an agreement with a facility to issue euro notes in his own name for a period of time, generally lasting from 3 to 10 years. They are sold at a discount from face value and pay back the full face value at maturity. They have maturity typically ranging from 3 to 6 months. They are attractive to borrowers because the interest expense is usually slightly less in comparison to syndicated Eurobank loans. Euro commercial paper. Euro commercial paper, like a domestic commercial paper, is an unsecured, that is, it doesn't come with a collateral. It's an unsecured short-term promissory note issued by a corporation or a bank and placed directly with the investment public through a dealer. It is sold at a discount from face value like euro notes. Maturities typically range from 1 to 6 months. The vast majority of euro commercial paper is denominated in the euro and the US dollar. Euro commercial paper issuers tend to be of much lower quality than their US counterparts. As such, yields tend to be higher because, right, the higher the risk, the higher the return. Euro dollar interest rate futures contract. Euro dollar interest futures traded on the Chicago Mercantile Exchange Group of exchanges and the Singapore Exchange are especially important contract. The euro-dollar contract has become the most widely used futures contract for hedging short-term US dollar interest rate risk. The Chicago Mercantile Exchange euro-dollar futures contract is written on a hypothetical $1 million 90-day deposit of euro dollars. The contract trades in the March, June, September, and December cycle and the 4 nearest non-cycle months. The contract is only cash settled, right, and trades out 10 years into the future. The international debt crisis. The international debt crisis was caused by lending to the sovereign governments of some less developed countries, or LDCs. The crisis began on August 20th, 1982, when Mexico asked more than 100 US and foreign banks to forgive its $68 billion in loans. Soon after that, Brazil, Argentina, and more than 20 other developing countries announced similar problems in making the debt service on their bank loans. At the height of the crisis, less developed countries owed some $1.2 trillion. The The source of the international debt crisis was oil. U.S. banks claimed there was official arm twisting from Washington to assist the economic development of the LDCs. Debt for equity swaps. A debt for equity swap is the sale of sovereign debt for US dollars to investors desiring to make equity investment in the indebted nation. As part of debt rescheduling agreements among the bank lending syndicates and the debtor nations, creditor banks would sell their loans for US dollars at discounts from face value to multinational corporations desiring to make equity investment in subsidiaries or local firms in the LDCs. The LDC central bank would then buy the bank debt from a multinational corporation at a smaller discount than the multinational corporation paid, but in local currency. In local currency. The multinational corporation would then use the local currency to make pre-approved new investment in the less developed nation that was economically or socially beneficial to the LDC and its populace. During the LDC debt crisis, a secondary market developed for LDC debt at prices discounted significantly from face value. The secondary market consisted of approximately 50 creditor banks, investment banks, boutique market makers. What was the solution to the international debt crisis? Brady bonds. Okay. The U.S. Treasury Secretary Nicholas F. Brady of the first Bush administration is largely accredited with designing a strategy in the spring of 1989 to resolve the international debt crisis. Under Secretary Brady's solution, creditor banks were offered one of three options. The first was convert their loans to marketable bonds with a face value equal to 65% of the original loan amount. The second option, convert the loans into collateralized bonds with a much reduced rate of 6.5%. These bonds came to be known as Brady bonds, and I will talk more about this on the next slide. The third option, banks could lend additional funds to allow the debtor nations to get on their feet. As anyone would expect, very few banks chose the third alternative. Very few banks chose to lend additional funds to the debtor nations, and that can be understood, right? Now, we mentioned that the second option gave rise to what is today known as the Brady bonds. So Brady bonds are loans converted into collateralized bonds with a reduced interest rate devised to resolve the international debt crisis in the late 1980s. They call for extending the debt maturities by 25 to 30 years and the purchase of the debtor nation of and the purchase by the debtor nation of zero coupon U.S. Treasury bonds with a corresponding maturity to guarantee the bonds and make them marketable. Okay. By August of 1992, 12 of 16 major debtor nations had reached refinancing agreements accounting for 92% of their outstanding private bank debt. Overall, over $100 billion in bank debt have been converted to Brady bonds. The Asian crisis. The Asian crisis began in the mid 1997 when Thailand devalued its currency, that is the baht. Consequently, other Asian nations devalued their currencies by allowing them to float. The crisis followed a period of economic expansion in the region financed by record private capital inflows. Bankers from the G10 nations actively sought to finance growth opportunities in Asia by providing businesses with a full range of products and services, leading to domestic price bubbles in East Asia, particularly in the real estate sector. Close interrelationships common among commercial firms and foreign investments in Asia resulted in poor investment decisions. Officially announced on December 1st, 2008 by the National Bureau of Economic Research. Okay. The credit crunch or inability of borrowers to easily obtain credit began in the US in the summer of 2007. The origin of the credit crunch can be traced back to three key contributing factors, namely liberalization of banking and security regulation, the global savings glut, low interest rate environment created by the Federal Reserve in the US in the early part of this decade. Now we look at the impact of the global financial crisis and the economic stimulus that was put in place to mitigate the crisis. Now, dramatic changes have taken place in the financial services industry, the auto industry, and in financial market worldwide. The Federal Reserve lowering interest rates to such a low level and keeping them there for such a long period of time was a mistake. Okay? Lowering the Fed funds rate is the rate of interest that banks charge one another for borrowing. So lowering that rate only added additional liquidity to the US economy and exacerbated Americans' unsustainable buying binge. New initiatives were made in 2008 to spur US and world economic activity. What was the aftermath of the global financial crisis? Well, the world economy has slowly recovered from the global economic crisis. Many lessons should be learned from this crisis, but two important ones are as follows. Bankers seem not to scrutinize credit risk as closely when they serve only as mortgage originators and then pass it on to mortgage-backed security investors rather than hold the paper themselves. Decision, the decision to allow the credit default market to operate without supervision of the Commodity Futures Trading Commission or some other regulatory agency was a serious error in judgment. Okay. Again, CDS stands for Credit Default Swap, and we'll talk about this in one of our future chapters. Anyway, this concludes our coverage of this chapter. As always, I ask that you be safe until we get to meet again. Take care.